Let me ask you something. Why did your grandparents retire with guaranteed pensions, but most people today retire with a 401k that depends entirely on the stock market? This wasn't some random accident. It was a massive financial shift that changed the very idea of retirement in America forever. Today, we're breaking down exactly how those old pensions worked, why companies were so desperate to get rid of them, and how the 401k system we all know took over. Back in the mid-1900s, pensions were pretty common, especially if you worked for a big corporation, a union, or in manufacturing. The deal was simple. You worked for the company for 20 or 30 years, and in return, they promised you a fixed monthly paycheck for the rest of your life after you retired. This is what's called a defined benefit plan. The company invested the money, the company guaranteed the payout, and most importantly, the company carried all the risk. If the stock market crashed right before you retired, not your problem. The company still had to pay you. Pensions were stable, predictable, and secure. But by the 1970s and 80s, big problems started to emerge for companies. First, people were living a lot longer. A 10-year retirement was turning into a 20 or even 30-year commitment for employers. Second, wild inflation hit, which meant companies had to pay out more to retirees just to keep up with the cost of living. And third, the stock market became much more volatile. But the biggest issue was this. Pensions showed up as massive long-term liabilities on a company's balance sheet. This made it harder to attract investors. It lowered reported profits, and it created huge financial risks during a recession. From a corporate finance perspective, pensions were just too expensive and unpredictable. Then, in 1978, a small change to the U.S. tax code created what we now call the 401k. It wasn't even designed to replace pensions at first, but companies quickly realized its power. With a 401k, the employee contributes their own money. The employee manages the investments, and the final payout depends on how the market performs. The company no longer guarantees anything. This is a defined contribution plan. The key difference: with a pension, the company carries the risk. With a 401k, the employee carries the risk. Companies loved this change. Their costs became predictable. There were no more lifetime guarantees. And those huge retirement liabilities vanished from their books. Now, here's the trade-off. 401ks offer portability, so you can change jobs and take your retirement account with you. They also offer higher growth potential through investing. But they demand a lot from you: financial literacy, discipline to save, and the ability to stomach market swings. The burden of retirement security has shifted from corporate America directly onto the shoulders of individual workers. Pensions didn't just fade away. They were pushed out so companies could reduce their risk and cut long-term costs. The system has fundamentally changed, and now, your retirement success depends on how well you understand the world of investing. That's why financial education matters more today than ever before. Thanks for watching.